Hi, my name is Anton, and today is November 16th, 2022, and this is episode 39, titled Actors of the Financial Theater. Now, for the last 30 years, I've been watching the financial markets and the many actors of the financial markets, and it really looks like a stage to me, a great big national theater that we get to see every day that includes all the variety of comedy and thriller and suspense, death, heartache, and of course, even romance. And this has been a lot of fun to watch over the years. And the theater starts every day early in the morning as the curtains open, and the financial stage is walk on with the media pundits and the experts. And what they do is they're predicting to the audience, us, what they expect for the day. And many times these announcements are in the first act, are simply stating what we already know. But we as the audience love it. We get up early to watch them, listen to them, and read the scripts of this opening act that starts the stock market and the investment day. And the main stage, of course, is in New York, because that's where all intellectuals live, of course. And they can stroll on the stages early and in the morning, while us Pacific coasters are still sleeping and no doubt in their mind from late night shenanigans. Now, these actors that walk out on the stage are inspired and even compelled due to their great wisdom and academic knowledge of the financial markets to lecture us on what is the experiences of that day. And to their credit, they really care about us, and they want to keep us from harm's way. And that way, each morning, the opening act is a big, long, and sometimes extended late into the day, but the script is typically very short. And that line and script that they repeat and open the day with is repeated over and over again and repeated throughout the day. And the closing act, by the way, is done the same way. As the curtains open and these highly intellectual and insightful actors stroll out onto the stage, and they make pronouncements of wisdom such as the stock market will open lower today due to concerns of oversupply issues. Or they'll say Wall Street encouraged by rising corporate earnings. Of course, we all know this, and we just love it. Now, boom, once that announcement's been made, the oracles have spoken, that message will go out exactly verbatim to the rest of the marketplace. And it will be broadcasted on television, news outlets, and newspapers. And newspapers, for those of you under 30, are a wad of paper that are printed on and folded up and then held together by a rubber band. And we typically find them in the bushes every morning. And of course, it's broadcasted all over the internet. Now, the real players are the actors. What the actors are talking about are the politicians, the Federal Reserve, and of course, corporate CEOs. And this year, the focus has been entirely on the Feds and what the Federal Reserve and the members of the Federal Open Market Committee are going to do. Now, the funny thing about the Feds is that they're not a very funny group, and they never joke because they know every word that they say is going to be watched very closely by these opening actors, and watched so close that any misstep may produce some unintended consequences. The Feds are a very serious group of people and take their role very seriously. And their leader of this very influential group is the chairperson, who currently is Jerome Powell. And over the years, they have had missteps, former Fed chairmen, in communicating to the actors and the Wall Streeters, which is you and me, the investors, and then markets go in opposite directions and in quite erratic ways. But over the years, recently, they have gotten much better with their messaging and have been very clear. And in this year, they've been extremely clear with their objectives, which is to raise interest rates to slow inflation. No big mystery there at all. They've been stating that all year long. On November 3rd, Jerome Powell came out and made another statement after their eighth meeting this year. They meet seventh meeting. They meet 8 times a year, every 6 weeks, which is curious that they meet every 6 weeks instead of quarterly. But they meet 8 times a year, every 6 weeks. And on November 3rd, Jerome Powell in his speech stated what he's been stating all year long. And that is, and I'll quote, recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated, which is something they've been constantly concerned about, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures, unquote. So this is not any surprise to anybody. And even more less surprising, if that's a combination there, is they're raising the discount rate. So from 0 in 2020, it's now been raised by another 0.75% to 3 3/4 to 4%. So they've continued to raise rates, and their hopes is to slow inflation. And he repeated their rationale, in case nobody had been paying attention, of the process of how they make decisions and what they're going to do in future decisions. And he stated, and I quote, "In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In addition, the committee will continue to reduce its holding of Treasury securities and agency debt and agency mortgage-backed securities." What this means is they've been buying the debt that they issued years ago. Now they're buying them back and reducing that outstanding balance. And this was described in their plans for reducing the size of the Federal Reserve balance sheet in May. So they've been doing this quite some time. He continues saying the committee is strongly committed to returning inflation to 2% objective. So reiterated again, November 3rd, their focus is inflation back to 2%, currently 7.7%, which we'll talk about in a little bit. Now, the actors the next day that do this opening act of the day to announce the day, for the following 3 days, really didn't do much. They came out almost like a disappointing individual being told what they don't want to hear. And this is primarily because the opening actors, candidly, they like to see a lot of frenzy as a result of their announcements, and specifically for Wall Streeters to start buying erratically or selling erratically. But this didn't happen. And so investors were quite mild in their activity following the Fed's announcement, as well as the opening statements that were made the following 3 days. However, interestingly, Jerome Powell wasn't finished. And these opening actors and pundits in the financial theater completely missed one of the last statements in his speech. And what he said for the first time this year is that the committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. This is big. The committee's assessment will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures and inflation expectations, and financial and international developments, unquote. This is big. For the first time, Jerome Powell and the Feds and the committee are stating that they are now prepared to adjust their stance on monetary policy. This is huge. They never have said this all year long, and somehow the media pundits and the opening actors that start each day miss this message. And this is, I think, the Feds were very pleased because they know at some point they have to slow interest rates, and they know at that point the markets will probably respond very erratically. And so they probably were very happy that somehow in their message that the opening actors and the Wall Streeters missed this. But it is very good news that they're starting to entertain the idea of slowing down interest rates, which has probably been the key reason for this economy and the stock market slowing down, which is exactly what they want to do. Clearly, rising interest rates have shut down the mortgage lending market. The refinance market is down over 90%. House buying is down. Construction is down. So the impact has been there. And so it's quite exciting to see that the Feds are actually talking about slowing their rate policy. But interestingly and comically, last week on Wednesday, the same actors and experts that missed the Fed's statement came out on Thursday very excited and announced with a lot of enthusiasm, inflation is slowing. And the reason that they said this is that the Bureau of Labor Statistics, which is a whole nother group of people that we know very little about, were reported that the consumer price index increased by only 0.6% and increased at a slower pace instead of the projected 0.8%. Most importantly, that the consumer price index is now the fourth consecutive month in a row that it has slowed its raise. What the Econoday, which is one of the other actors of the day, but a more reliable group of people, what they said is that, quote, inflation data brought some relief with monthly consumer price gains steady at 0.4% in October, prices up 7.7% year over year, and down from 8.2% the previous month. Forecasters in the Econoday survey had anticipated an acceleration of inflation, with prices gaining 0.7% in a month and 0.8% year over year. The lowest estimate of 7.8% and 7.7%. The 12-month inflation rate is the lowest since January. So this is very good news, and what prompted the very frenzy that the Feds were worried about. And in 2 days last week, Thursday and Friday, the stock market soared. Investors came with enthusiasm. The NASDAQ index rose 9.71% in 2 days, S&P 6.49%, and Wall Street and the Dow Jones, which is now the turtle of the group, lagging way behind, rallying only 3.3% in 2 days. This is the very rally that the Feds were worried about and happened a week later. Now, fortunately, over the weekend, these very same Wall Streeters investors had lost their enthusiasm, maybe even second guessing the buying they did 2 days earlier, came out this week so far very mild with very little activity, and the market's barely moved in the last couple of days. So what does this mean to me? So us Wall Streeters and investors, we're a very eclectic group of people, from doom and gloomers to very high wild speculators taking chances on inconceivable opportunities. And we have quite a range. And ourselves, at Up Capital, we consider ourselves the more fun, optimistic group of people and looking at situations in the positive view. Our announcements that we make to you on our own stage, which is a podcast, and the weekly briefs that we mail out to you. And for many years, we were on the big stage on CNBC, but now we're on the small stage performing just for you. We like to stay positive and looking at the opportunities of the current markets. However, we don't ignore the negative that's out there. We don't try and sugarcoat when we do see situations that may put you in harm's way. And we did this in 2006 when we were concerned about the 2008 recession that turned out to be the Great Recession. And we were fortunately out of the way of that. And that saved both us and our investors of huge losses. But right now, companies are growing. The economy is good. And when you look at 2008, the economy was not good. And if you had missed getting out of the market in January 2008 and held, you would have had to wait 3 years to get a full return on your money and get your account back to where it was. 3 years in a bad economy. In a good economy, after a big sell-off like we're having this year, it can be 6 months to 18 months. So almost as much as maybe half of a time period that it takes to recover in bad economies. And we're in a good economy. And why do I think we're in a good economy? Households are in great shape. We have more people working in this country than in the history of this country. And in fact, if you're not working, there's 11 million jobs waiting for you. And then unemployment is at 3.5%, and only twice in history has it been 3.5%. And then also, if people are working, but their mortgage, which is their biggest expense of their budget, is fixed for many people below 4% interest rates, and some 3%. And I even have one client with a 1.75% fixed rate mortgage for 30 years. So we know that consumers are employed, their biggest debt, which is their home mortgage, is fixed for 30 years, and households are in very good position. The other thing that's very encouraging is that companies are making money. In fact, their earnings are going up this year, as reported by the financial marketplace, the energy marketplace, the retail. And so companies' earnings are going up while their value, their stock price, is going down. In fact, many are down 20 to 30% this year, and earnings are going up. In fact, if you go to our website and you look at the charts of our weekly brief that this podcast is based on, this is the widest range of earnings to stock price since 1988. This would be like in real estate, owning and seeing real estate in your neighborhood, homes going down 15 to 20% while rents are going up. That's a terrific buying opportunity. And that's exactly what's happening in Wall Street right now. When you see the stock market or the S&P is down 18 to 20%, what you need to be looking at that is that it's not down 18 to 20%, that stocks are on sale right now. They're at a discount of 18 to 20%. And I say this with confidence because these very same stocks have increased their earnings since January. So while their values are at a discount, 18 to 20%, their value of earnings have gone up. So this is a terrific buying opportunity and why we're advocating to be patient with your account. In good economies, as I mentioned earlier, recovery can be 6 months to 18 months. And we think we're in a good economy, and the patience will be rewarded by sticking with your portfolio through this time. In the meantime, don't get up early. You don't need to listen to the opening actors in New York. Enjoy the morning, have breakfast, watch the reruns. They'll be there for you all day long. Give us a call if you have any questions about your account or this podcast. We'd love to talk to you and help you with your account. We're open to having a free 15-minute conversation with you anytime you would like. We welcome the opportunity to be of assistance. This is Anton Bayer. This is closing out Wake Up with Anton, and we look forward to talking with you soon. Bye.